with 4.7 out of 5 stars on Amazon and 4.13 out of 5 stars on Goodreads, I offer you 3 essential lessons from the book, Stocks for the Long Run, by Jeremy Siegel. Cheerfully recorded by Cool Cat Investing. Lesson 1. Consider stocks for a long-term investment horizon. In August 1929, an iconic article, "Everybody Ought to Be Rich," was published. In this article, John Raskob, a business executive, claimed that by investing $260 a month in stocks, everyone can expect their wealth to go to $1,400,000 in just 20 years, a whopping 26.3% annual return. Quick note, these are inflation-adjusted numbers. Just 2 months later, the decade-long Great Depression of the 1920s began. Stocks dropped 89% and did not return to inflation-adjusted all-time highs for the next 30 years if we exclude dividends. As people plunged into the depths of economic depression and did not want to see stocks or anything related to equity markets, the article became a laughingstock and a farce. However, it turned out that this was a winning strategy anyway. During these 30 years, investing $260 every month into a broad index of stocks would have resulted in about $615,000 inflation-adjusted dollars. Bonds, a perceived safe haven by many, performed much worse. During those 30 years, investing in stocks have generated capital returns 8 times higher than bonds. In the United States, the historical performance of various asset classes since 1802 shows a dramatic outperformance of stocks, with a 6.7% total real annual return. The next best investment class was bonds, at 3.5% yearly inflation-free returns. Gold showed just 0.6% above inflation returns. Moreover, despite wars, depressions, pandemics, a shift from an industrial economy to service-based, and all the technological progress since 1802, stocks showed a remarkable consistency of returns. From 1802 to 1870, stocks returned 6.7% annually. From 1871 to 1925, stocks grew at 6.5%. And from 1926 to 2012, we saw 6.7% performance. The same 6.5% real compound annual growth rate was observed from the end of the Second World War. Stocks were not immune from periods of negative real returns, albeit these periods were much shorter. For example, stocks showed near zero compound annual growth rate for 5 years, between 1976 to 1981, and for 12 years, between 2000 to 2012. Saying this, we have to be mindful that, unlike bonds, there was never a period longer than 20 years when real total stock returns were negative. Ergo Lesson 1. Consider stocks for a long-term investment horizon. Lesson 2. Think carefully before investing in bonds. Now let's look at the other major investment class, bonds. Since 1802, long-term government bonds showed 3.5% yearly inflation-free returns. However, the returns of bonds were not as consistent, with 4.8% from 1802 to 1870, 3.7% from 1871 to 1925, and just 2.6% from 1926 to 2012. In addition, we saw 35 years of negative returns between 1946 and 1981. As you can see, to generate maximum returns over long periods, stocks are superior. However, a lot of people consider bonds to minimize portfolio volatility for pre- and during retirement years. Okay, let's discuss the price fluctuations and answer the following question. What would be an optimal yearly rebalanced portfolio of stocks and bonds to minimize volatility based on a target holding period? When we look at the data over the last 100 years, we can see. If you want to minimize the volatility of your portfolio with a holding period of 1 to 2 years, consider 13% allocation in stocks. For a holding period of 5 years, use 75% bonds and 25% stocks portfolio. For a 10-year holding period, you will need at least 33% stocks. For 20 years, 50% stocks is the best. For a holding period of 30 years, the portfolio with minimum volatility would consist of 68% stocks and 32% bonds. Now, let's look at the risk, measured as the maximum price drop, for both stocks and bonds. Stocks are much riskier over a 1 to 2 year horizon. However, over any 5-year period since 1802, the maximum price drop for stocks is about the same as for bonds, at 12%. For any 10 years, the worst performance by stocks is better than the worst performance of bonds. Moreover, stocks beat bonds on returns in 90% of all 20-year periods. To be even more precise, stocks never showed negative real returns in any 17 years. For any 30 years, almost 100% of the time, stocks outperformed bonds. There were only 2 times in the past 200 years when bonds slightly outperformed stocks in 30-year rolling periods. That happened in 1861 during the Civil War and, in 1981, during the Volcker interest rate hikes. This outperformance can be somewhat predicted by higher initial interest rates. Thus, as you can see from this graph, it is unlikely to happen anytime soon. Overall, historical data shows that stocks, over long periods, tend to outperform bonds in real returns, have smaller maximum drawdowns, and have a dominant role in a portfolio to minimize volatility. Ergo Lesson 2. Think carefully before investing in bonds. By the way, please let me share a word of gratitude to everyone who has chosen to support this channel. If you haven't yet, please consider doing so. The link is in the description below. Now back to the video. Lesson 3. Know what strategies are likely to improve your returns based on historical evidence. William Sharpe and other scientists introduced a CAPM model in 1964. This model shows that higher investment returns are achieved by taking higher risks. In the CAPM model, risk is defined as beta and described as a sensitivity of asset price changes to the fluctuations of the broad stock market. Beta equals 1 implies volatility of the asset price similar to the market. Beta higher or lower than 1 suggests an asset with higher and lower sensitivity respectively. The CAPM model implies that higher returns can be achieved by investing in assets with higher beta. This model explained about 66% of the historically observed returns. In 1992, Nobel laureates Eugene Fama and Kenneth French improved the model to include 2 additional factors, risk of value and risk of small size. Now, this 3-factor CAPM model explained about 90% of the historically observed returns. Risk of value can be defined in multiple ways, however, the most commonly used these days is the low price to earnings, PE, or price to book, PB, ratios. Lower price to earnings and price to book ratios indicate a situation when it costs less to acquire $1 of earnings or $1 of equity generated by the business, respectively. Risk of small size is commonly defined as the relatively smaller market capitalization of the business. Market capitalization is calculated by multiplying the price of a share by the total number of outstanding shares. Both statistics can be easily found on most financial websites. Let's test the CAPM model on the U.S. historical data from 1926 to 2018. Because of risk equity premium, the portfolio of 100% stocks outperformed the portfolio of 100% government bonds by an additional 4.1% compound annual growth. Portfolios tilted to small market capitalization companies showed an additional 1.9% yearly premium. Investing in value stocks improved returns by an extra 3.8% annually. These premium returns were consistent across time. In any 10-year rolling period, the stock market premium was positive in 85% of the periods. The small capitalization premium was adding returns 72% of the time. And value premium generated additional real returns in 84% of 10-year periods. It is important to note that the value premium is much more uniform across time than the small cap premium. In other words, value premium tends to be closer to 3.8% in most 10-year periods. Small cap premium of 1.9%, although positive in 72% of 10-year periods, had a higher degree of volatility, with very pronounced periods of lower and higher outperformance. But what about the global markets outside of the United States? Although data is only available from 1990, we see the positive premiums of 2.3% for stocks over bonds, 0.1% premium for small cap stocks, and 4.3% for value stocks. The equity premium was positive in 81% of any 10-year rolling periods. Small capitalization and value premiums were observed in 82 and 72% of periods, respectively. What would an additional 1.9 and 3.8% annual return do over 40 years if you allocate a fixed portion of your income to a retirement fund every year? All other things being equal, you would end up with a sum about 4.6 times the size of a portfolio having only S&P 500 index exposure. If you consider investing a lump sum for 40 years, the difference is roughly 8 times. Please note, since 2008, the small cap value stocks underperformed the market. This made many market participants question whether the additional return premiums still exist. Ergo Lesson 3. Know what strategies are likely to improve your returns based on historical evidence. Thank you so much for watching. If you enjoyed this video, please like, subscribe, check our other videos, and consider supporting this channel. The link is in the description.